Hey, hey, hey. What's up, sons? Welcome to yet another episode of the Crypto Mining Show, the one-stop shop for all cryptocurrency news from the perspective of a cryptocurrency miner. We do these every weekend. It does look like Sunday will be the schedule just because it fits into my schedule quite well. Today, we're going to be talking about decentralization as it pertains to a lot of these new coins online. Some trends that I'm seeing on new coins. A reason why, as an old school cryptocurrency enthusiast miner, I'm not really on board with the direction a lot of coins are taking. And we are also going to be talking about BlackRock and an opinion article about BlackRock ETF not being possible without cryptocurrency miners. So without further ado, let's watch the ad and get into it. Today's sponsor is BT Miners. BT Miners has been a longtime sponsor of the channel and a proven reliable source for ASIC miners. If you're looking to purchase ASIC hardware from Bitcoin to Dogecoin miners, they are available for purchase on bt-miners.com. BT Miners is a trusted source by both ASICminervalue.com and CryptoMiner.com. Follow the affiliate link in the description and tell them SOT sent you to support the channel. Okie doke. Welcome back, everyone. So we got a couple of famous YouTubers up in the chat. Make sure you guys go subscribe to Seb's FinTech channel, as well as the Hobbyist Miner. I think there's even some videos with me over on the Hobbyist Miner channel if you want to go check them out. First things first, I do have this opinion piece, but we aren't going to be doing a lot of article reading today, just this one. This is an opinion piece from CoinDesk, and this always bugs me. Bitcoin mining is what they talk about, and then they put a picture of a GPU miner here. But, you know, it is, look, mainstream media, right? What are you going to do? At this point, I think we can call CoinDesk mainstream media, which is kind of funny. A BlackRock Bitcoin ETF wouldn't be possible without Bitcoin miners. I mean, kind of duh. Right, at the end of the day, it's like, well, the entire network is run by miners. Without miners, you can't process transactions, and therefore there would be no capability of the network actually even functioning. So, of course, without miners, the ETF wouldn't be possible. Bitcoin wouldn't be possible. We wouldn't be, cryptocurrency would not be possible without miners. So, if you're a miner, no matter how small, no matter how large, congratulations, none of this shift into digital finance would be possible without you. You are truly a revolutionary, and I commend you, good sir. With institutions like BlackRock, Fidelity, and ARK Investments all seeking SEC approval for Bitcoin ETFs, it's time to thank Bitcoin miners for laying the groundwork for industry expansion. All eyes are on BlackRock. After last year's carnage of FTX and other high-profile fallouts, the crypto industry is pinning its hopes on legacy finance muscling through the long-awaited Bitcoin spot ETF. In addition to BlackRock, Fidelity, and ARK Investments have filed for Bitcoin spot ETFs, paving the way for institutional capital to flood into the digital asset. Crypto exchanges like Coinbase, who will be BlackRock's surveillance sharing partner for the ETF, may clash with the SEC, but Wall Street routinely works with the agency to push through these financial products. While it isn't a guarantee we will see a Bitcoin spot ETF soon, even BlackRock isn't immune to the SEC's stonewalling, and its surveillance partner remains under investigation. It is looking increasingly likely, especially with the pressure of multiple firms coinciding with the momentum from Ripple Labs' partially successful lawsuit. That lawsuit is barely successful, in my humble opinion, because it is kind of weird. I did want to bring this up about Ripple, just because obviously this is a show where I ramble, so I'm going to do this little tangent here. The case with Ripple is interesting because, as far as I understand, it is still considered a security between financial institutions and like banks and partners like that. And seeing that that's the primary listed consumer for, or target market for Ripple, it's kind of like its entire reason for existing at the end of the day is a security still. I don't know. Just my 2 cents on that debacle. The arrival of a spot ETF would be a milestone for crypto and is made possible by the miners who have ensured the integrity of the Bitcoin network. From early test validations following the publication of the Bitcoin white paper to the build out of entire operations across the United States, Asia, and Europe, the past decade has been fascinating for mining, and miners again find themselves at a crucial inflection point to shape the industry as stakeholders. In the years leading up to the recent flurry of spot filings, publicly traded mining companies were how institutional investors gained exposure to Bitcoin. Due to the lack of regulatory clarity for digital assets, investors opted for traditional financial vehicles with stock offerings and compliance requirements, which also alleviated the burden of self-custody. While several other low-maintenance options existed for exposure to Bitcoin, including purchasing MicroStrategy stock or the Grayscale Futures ETF, miners were always closer to the core product. The inevitable spot ETF, backed by a major financial institution like BlackRock or Fidelity, is bittersweet. Approval of any one of those ETFs by the SEC would signal a regulatory green light while providing investors with direct exposure to Bitcoin. There would likely be a price increase in the underlying asset, which miners have spent this decade building substantial positions in, i.e., everyone involved makes money. But a spot Bitcoin ETF also raises the uncomfortable prospect of outflows in capital from mining stocks to Wall Street financial products, wherein banks enter a more favorable regulatory climate and benefit enormously from operating expense ratio fees built into their ETFs. As I highlighted in an op-ed for CoinDesk this spring, miners will meanwhile face a lower margin environment with the halving event next year set to reduce the amount of mineable Bitcoin by 50%. The fear surrounding the halving this time around has been very interesting. I was having this discussion actually earlier today because if you've been in cryptocurrency long enough, you're fully aware of its cyclical nature in the 4-year cycle and how the Bitcoin halving impacts the price of the entire cryptocurrency market. And it's interesting that there's this fear that miners are not going to be profitable enough on Bitcoin, when in fact you should expect, of course, this price to directly relate to the power it costs to mint Bitcoin. In fact, the price of every cryptocurrency, which we are going to talk about today, is directly related to the cost to mint that coin. And for whatever reason, we have a bunch of people running around talking about doom and gloom for Bitcoin on one hand, saying, you know, the price to mint's not going to affect it and they're going to have lower energy costs and blah, blah, blah. And then on the flip side, you have people that are so bullish on miners like the kaspa miners that they don't even take into account the fact that the cost to mint a kaspa after the ASICs are released is so incredibly low that there's no way it won't affect price. I just don't understand why these fundamentals are being completely ignored from the very get-go on all fronts. It's frustrating because we've seen it play out so many times as well. It's not like it's rocket science. This is basic math, and this is the way cryptocurrency has found its price since its inception. And to think that that is going to not be the case in the future seems a little bit ridiculous, because all that happens if the miners can't make money off of the Bitcoin, they stop mining, right? That is what happens. Now, there is an interesting point here that I think I would like to bring out as far as this article points out, which is the outflows from basically large public miners to the ETFs and a flow of the money out, because people don't need the miners or public miners for this type of thing. In my opinion, this is a good thing, because the point of Bitcoin is to be more decentralized, especially on the mining front, and not to be consolidated under large companies. So money outflowing from these large institutional miners and going into an ETF means that the larger mining companies will have a more difficult time at surviving, because they're reliant on these public funds and their traded stocks, etc., and hopefully shifts back into a more decentralized manner. Is that a possibility? I suppose so. Is that likely? Probably not, right? Because at the end of the day, if BlackRock is looking at this along with like any of the other institutional investors, they realize the value of miners as well. In fact, recently I did see that a large institutional investor was going in and purchasing a bunch of shares for a bunch of publicly traded miners. So at the end of the day, really, I don't think that shifts. I do think we still continue to see consolidation forced basically in the mining industry. A bunch of mergers and acquisitions continue. Right now, I think it's kind of done until miners, publicly traded miners specifically, or really miners as a whole, make the exact same mistake they made last bull run, which is wait until the miners are way overpriced and take out a loan on them. And then the price of those miners come down and they can't make their loans. If that same process is repeated, it will be quite laughable, because once again, it is absolutely hilarious how simple it is to see this cycle take place. And it's a very clear picture. I mean, we can almost pick the exact price of what Bitcoin will be in 2025, and subsequently can almost pick exactly what it'll be in 2027. Like I've stated before, the cycle continues until fees match the block reward, and we're still quite a ways off from that. I thought possibly what we would see was this to start taking place with the introduction of ordinals, driving the price of fees up, or the amount of fees up on the Bitcoin network. But ordinals never really took off to that extent. And by the time they are possibly bullish in that manner, I would assume that there is some sort of way to solve all of those fee issues as well. Let's continue though. It says the next era of mining. Miners, however, have always been aware of the timeline surrounding mineable Bitcoin as first outlined in Satoshi Nakamoto's white paper. The beauty is that we have created a playbook for bridging emerging technology, institutional investment, and alternative sources of energy while providing economic opportunities to the communities who welcome it. While Bitcoin's proof-of-work system may seem limiting on first glance, miners have used it as the basis for our own decentralized network with footprints across multiple jurisdictions, instantly adaptable to regulatory tailwinds and technological advancements. A Bitcoin spot ETF validates the validators. Its arrival would be a sign that securing the network always had global significance, and that there is even more of a role to play as promising new technology finds its place in the global economy. I think this is also something that's been extremely clear in the book, The Soft War, which has now been pulled down off of shelves. You can't order it, but there are a ton of PDF copies. If you can go get your hands on a PDF copy, I highly recommend reading it, because the key term here, of course, is the global significance of securing the Bitcoin network. Now, when we talk about Bitcoin at the end of the day, compared to everything else, there is no close second to the security of Bitcoin. And that is extremely important when you have to, when you're starting to understand its role globally, right? Because what we are going to see as laid out in Soft War is a battle for power over the Bitcoin network, because at this time now we don't have the capability as an individual nation to attack the network. Almost every other network There is some capability of, if a government decided they wanted to attack it or manipulate it, they could do so. But with the amount of power securing the Bitcoin network, it has become basically impossible at this point. As Wall Street and regulators debate the specifics of a spot coin ETF, miners are developing profitable business models with Ethereum and artificial intelligence, making the ETF debate already seem dated. I noted another CoinDesk piece from earlier this year how company Bit Digital had developed an Ethereum flywheel model wherein mined Bitcoin can be converted into Ethereum and then staked for rewards. Mining infrastructure such as alternative energy sources, cooling systems, and computing systems likewise are being used to process machine learning workloads. Those who would call this a pivot misunderstand the fluidity of mining and how the sector has grown beyond Bitcoin to offer investors exposure to Ethereum and AI, while incorporating emerging technologies requiring energy output into a sustainable model. Again, miners are innovating and tapping into the promise of new markets and technologies as Wall Street plays catch up years after the fact. A spot Bitcoin ETF heralds a triumph for the guardians of the network. Our full power is only just being realized. I wonder if this guy's a miner because he says our full power. And really at the end of the day, that is what it's going to come down to. It's not even Bitcoin in general. Soon the conversation goes back to power generation, right? And who can generate the most power? I mean, energy, power, that has always been the number one thing. All Bitcoin really is a realization of that into an asset, right? And so if you talk about like global powers vying for control, it does always come down to energy. And what's awesome about Bitcoin at the end of the day is that it is a representation as a, currency or commodity of energy. It is energy monetized, and everything is energy. And that is basically why Bitcoin is going to be relevant. Now, we've had a brand new shift happening this bear market. So in previous years, the entire push surrounding cryptocurrency went through a few different iterations, right? If we talk about the cycle basically pre-2016, the talk was primarily around the fundamentals of cryptocurrency as it pertained to the Bitcoin white paper, right? A decentralized peer-to-peer network that, eliminated the third parties. And by and large, that has, been the staple for cryptocurrencies to be a cryptocurrency. But a part of that is like decentralization has to play a part in that. And then that kind of started going to the wayside. It wasn't the most important thing. Security was kind of the next thing, or privacy really. And privacy really surrounded around these trends of, basically being able to keep your transactions private from the public or from governments as well as banks too. And then we had this whole new spin up of interesting cryptocurrencies surrounding that, with very few kind of taking their place and sticking around, right? Maybe like the Monero, but like the Zcash stuff all went away and whatnot. And then the talk around 2016 or even maybe 2014, really, there became this talk once the realization of ASICs hitting Bitcoin was at play, and the control that ASIC manufacturers started to begin having over networks, specifically like Bitmain in this case, there became a push for what was known as basically like ASIC resistant. Because remember, if we go back to the Bitcoin white paper, the idea was one CPU, one vote. And that means that every individual that had any sort of computing power could be a participant and earn a portion of the block reward for themselves. And what this did and what this means, like from the very base, is that if you are an individual that has a computer, you can put that on a network, support that network, and earn something in return for doing that. And cryptocurrency in general has moved further and further away from this. We started out kind of strong, like I said, in 2014 to 2016, where every new coin that was coming out, it was all about ASIC resistance, all the way through 2018 with the launch of like Raven coin, right? Like there were a lot of people working on this. Oh God, a girl doing a ton of good work on this, for example. And the idea was to basically make it so that it was GPUs that we moved on to from CPUs, primarily because if you have a CPU mineable coin, because of the architecture of a CPU, it is almost certain that you will always get to some sort of, or get close to some sort of ASIC in most cases. There are things you can do like Monero did and so on that make that not as big of a deal, but just to give you some background on that. So it really went into GPUs, and GPUs are very special for mining cryptocurrency because they have a consumer market, right? Any individual can go online or go to their Best Buy locally, pick up a GPU for a relatively low cost, go home, plug it into a motherboard, and begin mining and supporting networks. And this means that you have higher participation across the network as well, because if somebody is mining it, they're probably going to begin participating within the network, which means you have a much stronger distribution for newer coins. This is why the evolution of Bitcoin looks a lot different than the evolution of coins that are even just forks of Bitcoin. And the reason for this, of course, is that Bitcoin, the ASICs hadn't been developed yet, so there was a long timeline of CPU miners and a long timeline of GPU miners. But once there were manufacturers for ASICs and bitstream developers for FPGAs, the timeline for these individuals to figure out the consensus mechanism and figure out the stratums and the pools and the way they need to program and build these units, the timeline shortens significantly, right? And because of that, you can't have the same distribution across these newer coins that are already predetermined and pre-planned to move into ASICs. And the other interesting thing apart from this, if you want to throw on a tinfoil hat with me, is that there's a ton of money-making potential in actually developing an ASIC coin, and Bitmain being a part of that. And that can put you in a good position to where there's actually now, in my humble opinion, based off of the way you see the distribution across the rich lists in most of these new coins that are going to be moving to FPGAs and ASICs, is that there are potential rug pulls sitting here in a lot of these coins. And you'll kind of start to see it as we play along, because there isn't that distribution time that Bitcoin had where anybody could mine it with a CPU or a GPU. And that kind of translates over, but at an accelerated timeline. So this is kind of the topic that I really wanted to get into today, because this bear market cycle has completely taken a huge tangent away from what we've seen previously, with ASIC resistance being on the top of everybody's mind, right? Now, ASICs are accepted, in fact, encouraged by most of the networks that are being released now. Most of the coins that are being released now have some sort of ASIC plan in their white paper, or they intentionally say that they are developed and ready for ASICs. Almost all of them, right? And the ones that aren't, maybe they were just misguided and didn't even think about the algorithm they were choosing in the case of something like Ironfish. But then once they start seeing the DMs in their Telegram from Bitmain, I'm sure they go ahead and jump on board, is what it appears like. Now, of course, the first one in this that we'll talk about is kaspa. Now, kaspa is unique in a couple different ways. Obviously, I've been very bullish on kaspa, still bullish on kaspa, but it doesn't mean that we don't look at this objectively and say, hey, like, what's really going on here? Is this a healthy network? Is it not a healthy network? What does the distribution look like? And where are we really headed in the future? Now, kaspa, because of the speed of the network and because of the amount of coin that can be spread out within a 60-second block time, and basically to each individual nodes, picking off and winning new blocks, there isn't as much of a concern with the supply side. And because it was new and unique, there was, what I would say, out of all of the new coins, a longer time for development before it hit FPGA as well as ASICs to actually distribute. And you'll see this in the rich list. It actually distributed out much better than others, but the distribution is still pretty consolidated at the top. And right now, what we've seen on kaspa, of course, is the shift into FPGAs and then into ASICs. Right now, Ice Rivers being the primary on there. It has hit, it's come down from its all-time high, down from like 2.6 petahash to 2.5 petahash now, but it does have a bunch of unknown blocks that are hitting it. Now, there was a new shift in the fact that the Ice River machines now can mine to a node. So it's more beneficial to mine to your own node on this network, once again, because of the amount of blocks that are found and how fast the speed is, right? And it'll be even more pronounced later on down the road with like a Rust implementation or whatever. But we're still looking at 53.6% of the rewards going to unknown miners, essentially. And you have to ask yourself, what is that really? And do we have to worry about these miners having too much control over the actual supply of the coin? Now, you could say on one hand, well, the control is going to be fine as long as the miners don't actually want to do anything malicious to the network or are not overly concerned with the amount of money that they are making right now. And I think to a certain extent, as far as the individuals that have purchased the Ice Rivers because they're in lower quantity, I would say most people are mining this, seeing the massive amount of rewards, but then holding on for it to go up in value. That may shift depending on like what happens in the future. Now, we did see the traditional business model of FPGA take place on kaspa. If you recall, basically FPGA spun it way up. We had extremely high distribution to unknown. And then we saw that dip down, you know, from the 4 cents here, most recently getting very close to the 1 penny, didn't go sub penny, started to recover, right? But that nature was a mining driven nature. And that is a play that has been done in the past with FPGAs that as a GPU miner, I haven't always been completely acutely aware of. And luckily, Mean Hash explained this, showed me examples from the older days, you know, when we were seeing these on some of the other coins and so on. I was like, okay, I see this is a business model. This is the way it works. Now, Bitmain does this at a much larger level. And most recently, we saw that happen on Kadena, right? Where they essentially pump up the coin, they mine a bunch of it, and then after they ship the miners, they dump it off. This is a risk with all of these new coins. It's a business model run by both FPGA and ASICs, and it's something to take into consideration. Now, as far as kaspa goes, I am aware of all of the arguments outside of this. It solves the trilemma, and it has portions in there that are make it more secure. You know, I think even claims of it being second to Bitcoin, which I don't agree with because I think power cost plays a huge part. But I get all of the points. I've read them. I'm looking at this objectively from what we've seen in the past to what could potentially happen in the future. Now, let's look at why this could still be the case from a rich list perspective. And if we look at the rich list for kaspa, right now, what we see is the top 10 addresses own 17% of the network. Now, that includes exchanges, okay? So as you can see, MEXC, for example, is the #1 exchange with over $1 billion kaspa right now. $38 million, and 5.3% of the entire network is in MEXC as an exchange. This can actually kind of be a little dangerous, as we've seen before. If miners are moving into an exchange on Bitcoin, for example, we're expecting the price to go down. If Bitcoin is moving out of exchanges, we expect the price of Bitcoin to go up. That's the correlation. So such a high rate in one single exchange outside of, what the actual rich list is, can be a little bit concerning here. We also have 3% of the entire in KuCoin and another 3% in Gate.io. In addition to that, TextBit has another 1%, and we also have CoinEx with another 1%. A couple of other small ones, and within the top 10 here as well was the Rust Fund that they utilized for donations for Rust being sent to them. And as you can see here, they're doing pretty good. 3.5 million US dollar equivalent, 97 million kaspa, kind of sitting there for them to get Rust done. So I hope that means that Rust is going to be completed. The distribution in the top 100 is 36.255. And over 50% of the kaspa in the circulating supply is controlled by the top 1,000 addresses. Now, you usually are only worried about that if that's like above 50%, and that would be above 50% with, or at least in the past, and that would be above 50% minus exchanges, right? So if we looked at exchanges, we would have 1, 2, 5, 10, 13%, right? And so we're actually just under 50%. I think 48% of the circulating supply is in the top 1,000 addresses. I'll let you guys, interpret that how you would like. I wouldn't say that this is fantastically distributed, but it is much better than what you guys are going to see here with the rest of these. Okay, so let's go ahead and move on to a new fresh one on the list with Kyla Coin. Now, Kyla Coin has a different problem. Kyla Coin is completely centralized, specifically on Viper.net right now. Now, Retro Mike, who was in the chat earlier, it has a pool that has just been started. Correct me if I'm wrong here, but the fees are lower, and I would highly recommend Retro Mikes if you're stateside for mining Kyla Coin. Getting this responsibility is not just on pool ops or devs or anything else. In the case of Kyla Coin, the miners are failing the public here. A hard part with Kyla Coin, of course, is the restriction of the access to bit streams to Hash Reactor and K1. And then maybe if you have or own an E300, you can get access to it as well. But that is this has gone through that FPGA kind of push here. And you can see it, on the charts. There were definitely a lot of FPGAs that came online, so much so that it didn't make it profitable, and then they've cut back down and it's found its equilibrium here. But all these FPGAs are also going elsewhere, so you need to take that into account. Now, the rich list on Kyla Coin doesn't give us all the fun metrics, and I don't know if this is an exchange. It probably is at 269, but it does feel quite consolidated as far as distribution in the top 100, I believe it is. Yeah, something like that. The top 100 is pretty consolidated. You start getting down to ones and so on from there, but it is a very new network. It is something to pay attention to, though, because it does mean that everything is going through essentially one pool owner, who I personally know, by the way. So I have nothing against the pool owner, and I realize that these things happen. But as miners, it's our responsibility to spread this hash rate out. Now, I would say previously, in most of these cases, the problem we have is that the FPGA mining community is extremely small. The FPGA mining community keeps everything very close knit. They keep the bit streams to themselves so that they can remain profitable, and they suck up a bunch of volume so that they can basically manipulate the market however they like. And you need to keep that in mind when you start playing with these coins that are taken over very, very early by FPGAs. It's really just sitting there waiting for something bad to happen in the economy to where they need to pull out and the entire coin tanks. And that's really across all of these, right? So there's very high risk and there can be high reward here as well. But keep that in mind when we're talking about a lot of these. And it wouldn't even be something that you would say, oh, they rug pulled. It could literally be, oh, the economy's in the shitter and people aren't developing anymore and they just need to pull that coin. They need to pull out of that coin. And they pull out of that coin and it tanks the whole market. And it starts to look a lot like DeFi looks now, right? I don't know if anybody's messed around with DeFi in this bear market. But if I go into DeFi and I go through all of the tokens I have from just stuff people sent me trying to promote their token, fools, you guys know I don't do that. So I have all these shit tokens, right? And I go to like a DeFi platform and I'll go to see if I can like get it. It'll list the price, right? Like I have this one that's hilarious. It says I have like $2,700 worth of it. But if I try to like click to like swap it to USDT or something, it's like you would affect the price too much if you sold all of this, right? And that is what essentially is happening. DeFi, what's nice about it is it's at least more transparent and you can see that up front. On the centralized exchange side of things, it's not so apparent, right? So when these things are getting sold through the centralized exchanges, it's just not very clear, right? So I don't have as many metrics on Kyla Coin right now. Like I said, it is pretty new. A lot of these large wallets are probably exchange wallets. I do not think, at first glance that this is very good distribution. And they can all impact price pretty significantly if they decide to sell. Because if you go look at Safe Trade or TextBit, for example, right now with Kyla Coin, your shift in price, your 2% depth is like one Kyla Coin, right? Like if you own one Kyla Coin right now, you can pretty much shift that price all by yourself by like 10% by just selling it. So keep that in mind. Now, Alephium. Now, we've had Alephium on the channel. We did an interview. If you guys want to go check it out. Now, Alephium has about 21% of the unknown. Hero Miners is way too much of the hash rate. 81%. It says 48% of the blocks are being found by Hero Miners, which is pretty incredible that they have 81% of the hash rate and then 48% of that, only 48% of the blocks. You would expect that to be much higher. So I'm not sure what's going on with this unknown. If there is, oh, there we go. Okay. Well, something may be messed up with the API here. It says that 95% is being found. Now, what I found interesting on Alephium is not so much this. Once again, this is just a lesson in needing to spread out the hash rate as miners, but they are probably getting hit at this point by private bit streams. There are no public bit streams for this that I've seen yet. So, Hash Reactor K1 doesn't have any for Blake 3. Alephium, and I haven't seen it hit any of the like Team Red Miner or anything along those lines. But, you know, the rich list is, I think, all in gate.io at $2.1 million. So once again, what we're seeing is very, very high exchange amounts. So if you're talking about, once again, if you're talking about FPGA private bitstream strategies, mining strategies, what is happening here is they take a large portion of the block or of the block rewards and they stuff it into an exchange so that they can have control over it. 1 second. All right. So here's the rich list for that and the distribution. And you'll just start to notice that, like, we end up having very poor distribution the further and further and further down we go, right? This one's consolidated really into the top 5 very heavily, which is interesting as well. Nexa is another one that actually, this one has really good pool distribution, it appears, as far as comparatively, right? 42% of the hash rate's still pretty high on cryptex.com. We don't have any weird unknown stuff going on, but Nexa is one of those that Nexa proof of work is somewhat, so Nexa proof of work probably won't see FPGA or ASICs on it because already in the roadmap, Nexa has a plan to move to ASICs, as well as working with an ASIC manufacturer to build ASICs for a specific algorithm that they're working with the ASIC manufacturer on. More details on that you can hear about with, of course, on the interview that I did. But my assumption behind that is it could go one of 2 ways. One, it's being done to make it more efficient, right? Which would be a positive. 2, it could be what I would call a transparent, maybe a, what is it? An actual, we might actually be being told exactly what's going on with all the rest of these coins directly by the roadmap on Nexa. Like, this could be the actual plan across the board for a lot of these coins, but Nexa just told us about it. Does that make sense? Which is kind of interesting. Now, the distribution on Nexa is actually quite laughable, I believe. I believe the distribution is at 39% in the top 25. Extremely high. But of course, some of these could be pools. Not sure or not pools, but exchanges. I'm not sure how many of those are exchanges because they aren't marked like the other ones. But it is significantly higher than a lot of the other coins. I guess really kaspa would be at 34%, right? About, maybe a little bit more. Might be right on par with kaspa. The top 100, what is that? Maybe I'm reading this wealth distribution wrong, actually. Top 25 through 26. Oh, so you would add the percentage. Okay. So it'd be like 40, 47, 51, 54% in the top 100, or in the top 100, which would be over that 50% mark that we would be worried about. And then if that's the top 100, then it is, yeah, it is not distributed as well as like kaspa at this time. To be fair, Nexa is newer. Radiant is 43% on a single pool. No unknowns except for a little bit right here. Most of it going through Wooly Pooly and Viper. And then our top 1 through 25 is 18% in the top 25. And then if we add that total up, top 100 is 32%, which is about 4% less, a little bit more distributed than kaspa for Radiant. But that top 1 through 25 is, no, that's pretty well distributed then. But Radiant is, here's the interesting thing about Radiant, at least as far as I've seen. The FPGAs are not, they're about double the efficiency of the GPUs, but they're not so crazy efficient like they are on a lot of the other options that are out right now for FPGAs. So there's kind of that buffer, I think, that's happening with SHA 512 256D at this current time. I did pull like a couple other small ones up, like Chlor, because I've been looking at Chlor. We have 6% unknown, 51% on our plant, which could definitely be an issue. And their distribution right now for the total in the top 100 is 92%, if I understand that correctly, which seems a little high. I don't believe that could be correct, right? 38, 40, 41, 51, 61. Yeah, it's more like, because the Chlor AI rewards are all put into here. 92, so yeah, 78%, something like that. But I didn't really dig too deeply into this one. People have been asking about XNA as well. Now, XNA is interesting because there is a ton of unknown, but there's a ton of API errors. So right now, I can't really tell you all exactly what's going on. Our plant seems to be the most popular, most likely because of the automatic conversions going on there, and the profitability on for basically the Kapow algorithm seems to be going through that. And then outside of that, I'm not sure exactly because Kapow is ASIC resistant. So I wanted to look at that from a GPU perspective, though, and kind of look at distribution. It is also very new. And then the top 100 on here is 55%, right? So XNA is pretty new. And seems to have some distribution issues initially, but we'll have to keep an eye on it. And then Ironfish. Now, Ironfish recently has, this unknown has gone significantly up. There is a public bit stream from Hash Reactor, as well as the E300 is available. And you can see the hash rate started to come off for GPUs. And then once the FPGAs took over, the hash rate really skyrocketed. 68% of the hash rate is on Hero miners of the hash rate that is actually mining to a pool, because presumably somewhere around 63 or 60% of the hash rate overall is being mined to private nodes. Now, Ironfish is funny because Ironfish is a privacy coin, so we don't have a rich list, but we do have a very clear announcement of what their distribution will be. We're still under 12 months from their release, so it's less than 28% of the network in circulation from miners, and all of the rest of it is going to the foundation or developers or investors, right? So the potential for manipulation, like we talked about when we initially saw this, is very high. This would be the total distribution afterwards, with mining rewards being at 83.7. But now that we are starting to see basically all of those few mining rewards also go to specialized equipment, it seems like this will just be a good old boys club to me. It'll be the ASIC manufacturer. If they come in with Bitmain, it'll be the FPGA miner and the pool owners and nobody else here. Which means if you're going to play in this pond, you know, as you can look at the kaspa, you know, their little shrimp or whatever. I think no matter what, if you're trying to get into Ironfish, you're going to be a shrimp. You're going to have no influence over where this is headed in the future. Finally, Dynex coin recently did apply, and I talked about this because in my latest video about my problem with Dynex coin, they did apply their no more than 40% hash rate, and it appears to be working. So everything's sitting right at around 30% or less on the pools. There is the question of their unknown rewards, which is 0.1%. It does feed into the largest wallet in that has been able to be found. I know that, for example, Mind Something is looking into this. Another YouTuber, go follow him. But it does look like the unknown rewards, they were able to keep up and continue to mine. I would assume that that's going to be the developer or somebody that knows the developer that's running a private node. And then the rest of this has been spread out. There is no rich list, though, that's public. So they say that's because it is for privacy reasons. I think having a distribution of that would be okay. And it does say you can make them public. So I would encourage that at least the public, at least the people that have opted to be public with their, I guess, wallets, to be listed in some sort of rich list. I was kind of digging around in this one a little bit. There's a lot of research that needs to be done. But, you know, you can look at like a transaction hash, for example. And I don't believe that it it doesn't provide you any actual wallet address in any of the transactions. So need to do some more digging on Dynex right now, from the perspective that you have to have a mining pool, period, or you have to have the dev help you to even have a mining pool. I'm not a big fan of this in particular. You know, I think the argument is that it's proof of useful work, and this is just the best way to get proof of useful work to work right now. But it just goes back to show that we're really seeing a lack of decentralization in every project here. You know, we're having a lack of decentralization across a majority of the hash rate, right? We're seeing a lack of decentralization of the actual supply itself, which is beginning to get more and more centralized. And this isn't a case where it's an individual coin. This appears to be a trend across all coins. And I wanted to bring this up because I don't think it's the right path forward for cryptocurrency. And I don't know what the solution is, but I think the best way to find a solution is to bring it up and start bringing this to everybody's attention. So if I can talk to you guys about decentralizing the hash rate, then that is fantastic. And then maybe we can talk about, you know, strategies for future releases, for fair launches, to make sure that the coins are distributed as fairly as possible. There are a few projects I've talked about on sonofatech.locals.com that are new, but I don't think any of those actually solve this either. And I wanted to hear your thoughts and opinions on these trends. So that's why I decided to talk about it. So let's get into questions and answers and comments. Please tag at sonofatech and I'll be able to read it. In addition, you can also super chat, which are always appreciated and never required, but they are the easiest to read for me. So I'm going to go ahead and pop out the chat. I'm really curious what you guys are thinking along these lines, because this has been interesting to me across the board. Geek of All Trades says, at Sonofatech, do you feel like this bear market is different for GPU miners? How does the future of GPU mining feel for you? Are the days of the 3060 Ti making $10 a day ever going to return? So there's a lot of factors that drove, the profitability of the 3060 Ti up. And I would be amiss if we didn't mention the fact that basically we had an economic anomaly in the last bull run, where people had disposable income and were sitting on their asses at home buying stupid shit like NFTs, which drove the fees through the roof, right? So a 3060 Ti making $10 a day, maybe just because of the devaluation of the dollar that I think is going to happen, but not because of the actual value of that, right? You have to take those things into account when we're talking about, because that was purely Ethereum, right? Now, what is the trend moving forward? It definitely appears that like AI is a huge trend moving forward, and that will drive the demand for these GPUs up. Now, will it be through blockchain, or will it be more through, like Vast.ai? I would probably lean towards it maybe being more in the realm of Vast.ai and less in the realm of the less in the realm of probably cryptocurrency, if we saw that again, and that would be because of market demand, right? But I do think that we'll see profitable GPU mining again with proof of useful work. I think Dynex is definitely I can't complain with Dynex profitability right now. The shift into AMD being more efficient on Dynex has been really interesting as well. If you guys aren't paying attention, make sure you're looking into that, with some very good opportunities on used GPUs that are extremely efficient. Raven Crypto Boy says, at Sonofatech, did you see software got delisted? Yep, I did. I talked about that at the beginning of the show. But yes, it is very clear that what is happening is that it probably is true. Everything he said in that book is what I would say. Babelfish says, at Sonofatech, I think the KSO is the kaspa GPU parallel. Easily accessible? I don't know. In addition, it gets out competed, right? I don't think it is. I can't go to Best Buy and pick it up. Yeti says, at Sonofatech, what do you think? What did you think of my Dynex proof of useful work dashboard prototype that Dynex posted on Twitter today? I retweeted it. That's pretty cool. I like being able to see the jobs and everything. Good job, Yeti. Congratulations on that too. Thanks for the 99-cent super sticker, Retro Mike. Second TL Mining says, at Sonofatech, thanks for keeping the show going through the bear market. Hell yeah. D Miner says, making s'mores. What is up? Pool number 4 is me. And Yeti's pool. Ruro says, at Sonofatech, review discrete. It's DAG like kaspa, smart contracts like Ethereum, and private like XMR. The problem I have whenever somebody says all of those things, Ruro, is I've been along in crypto long enough that I see those marketing materials everywhere. So it's just kind of funny to me, right? Like back in the day, it would be like, It's ASIC resistant like Ethereum, super fast like Litecoin, and private like Monero. And then you'd mine it, and then it'd fucking take a shit on you and be sitting on a bag of nothing. Ah, the good old days. So I get cynical when it's like this and that. It's like, all right. But what is new about it is the question. You know, the coins that you should probably be interested in are the coins that you listed to describe the other coin. Right? Mind Something says, Asylum Attack, been thinking the same things lately. The way things are going now will come to an end. Software companies using crypto hype to fund development will end one day. Yeah, I think what we will see is, you know, if the economy continues to go on the route which it's going, and people struggle more and more to just pay regular bills, etc., the temptation for these large wallets is too high to dump. Right? So if you have a high consolidation of, you know, of it in small amounts of people's wallets or whatever, and they're under pressure to sell it because they need to, then it dumps the whole market, right? And that's not a dig at any individual project or any individual person. That is just human nature. So when you're looking at these projects and you're trying to find basically the argument for decentralization, it's that, right? Like the more spread out the coin is, the less likely you're going to have that trouble, right? And the more decentralized the network is, the less likely you have to worry about the network going away. Miner for 9 says, Asylum Attack, every other country has seen their currency fall in value. How likely do you think it will be for the USD to fall in relation to any other country and in relation to crypto? Extremely likely, in my humble opinion. We'll find out more on August 22nd when the BRICS nations basically review accepting 22 more countries and announce their backing of the BRICS reserve currency with gold. Then we'll really know what the impact on the US dollar is going to be. Do you think eggs and commodities will still cost about the same? I think eggs and commodities will cost about the same in Bitcoin, but not the same in the US dollar. Jorge says, how many X in a bull market could mean from now, son of a tech, 100X? I don't know exactly what you're asking, Jorge. Sorry. That's an hour for me, boys. Thanks everybody for watching. Be sure to hit the like, comment, subscribe, and notification bell down below. Sorry I started rushing near at the end. I do have more thoughts on all of those coins and more research, but I was trying to keep this into an hour because it is getting late. I do have to do some more work for the day job, and I got the kiddo to take care of. So there you go. Thanks for the $20 super chat. Retro Mike says Litecoin halving in 3 days. There we go. I will see you next Tuesday. Getting hot in here.